Welcome to the Wealth Studying Podcast. This is episode 510. Today is February 4th, 2026. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. We're in the middle of earnings season. All the reports from Q4 are coming out. Keep in mind, despite all the negative news you're hearing, all indications look like we're talking double-digit earnings growth for fourth quarter. And again, despite all the negativity and the fear about the unemployment rates and everything else is going on, GDP for fourth quarter hasn't been announced yet, but it's very likely going to come in higher than most people have estimated, somewhere 3, 4. I mean, some crazy people are even talking 5% GDP, but I think it's pretty solid that it's going to come in above 3% GDP to end out last year. So why are we seeing such a market sell-off? Why are we seeing the constant questioning of whether we're in an AI bubble or not? Well, before we get into any of that, just remember last week there were plenty of people telling you that gold and silver and other precious metals and commodities were all going to the moon, the US dollar was in a death spiral, but moved beyond the rhetoric and the sophistry and all the sales pitches. And where are we at? US dollar actually up more than, I think, 1% or so over the last week. And all the commodities have fallen well off their highs. Copper, silver, gold, all of them. I think gold down about 10% from its high. Silver down, more than 25, close to probably 30% from its high just a week or so ago. So don't let the headlines influence you. Consider all this stuff as static and noise. One day, a semiconductor company like AMD will be going to the moon. It'll be up 10%. The next day, it'll be down 10. I own uranium stocks that literally, from a daily basis can fluctuate anywhere up or down from 5 to 10%. I take it all in stride. I'm looking at the bigger picture. The story for 2026 and beyond is the geopolitical instability, reshoring of critical manufacturing, either to the United States or within the borders of friendlier countries. There is definitely an automation, an AI, a robotics, a digitization move. That means all the supply chains in terms of electrification and digitization are continuing to grow. Now, will they consistently grow at 30 or more percent? No, there's a business cycle to everything. That's why I maintain a diverse portfolio and why I ignore the headlines. Take a look at how the market has started out the first month of the year. Yeah, some of the big names, especially the hyperscalers, they're down, but not all of them, right? Google's still doing very well. Meta and Microsoft, not so much. But just a year ago, they were hating on Google and they were loving Meta and Microsoft. Markets adjust, people adapt. Things get overpriced. Then there's a panic. Then there's a consolidation. Things get repriced. Valuations get rationalized. But look at the bigger picture. The big winners, not only of pretty much ending last year, but definitely coming strong into the beginning of this year. Things like memory and storage devices. In my portfolio, that means stocks like Seagate or Micron. And yeah, AMD down today, but look at AMD and Intel. These are old legacy semiconductor names. They can be volatile day to day. But Intel over the last 12 months up close to 150%. AMD up probably more than 60% in the last 12 months. And again, stocks getting pounded today. Semiconductor equipment and material companies. From the portfolio, companies like Applied Materials, ASML, Lam Research, down as much as 10% today. But all these guys year to date, right, just in the last 30 days or so, were all up double digits, some of them 24, 20%. And looking out longer than that, over the last 12 months, Applied Materials up over 60%. ASML up over 80%. Lam Research, the big winner, up over 150% in the last 12 months. More big losers today. Ciena with fiber optics. Invertive Holdings, the infrastructure company behind a lot of the data centers. Yeah, bad day, but even year to date, right? Over the last just 30 days, both of these stocks up about 10% year to date, even with today's big loss, but going over the last year. Vertiv up over 50%, and Ciena, virtually a company no one's ever heard of, up 200% in 12 months. You can't pick the tops and bottoms on a daily basis. You go with the overall trends, and you don't let emotion or fear and greed affect you from day to day. Oh, let me step back here. As I watch YouTube videos, I've recently been hammered by the video of the guy that claims that he has an AI stock picking program that, to the penny, can predict the price of NVIDIA. Now, I know you're a listener of this podcast, so you're not stupid enough to fall for something like that. But think of all the people that do, and think about how their minds are not rational enough to understand that if this guy had a program that could accurately, to the penny, pick out stock prices ahead of time, that he wouldn't be wasting his time buying advertising on YouTube. What he would be doing is reinvesting in his own trading algorithm and not sharing the secret with anybody. But see, people, the average person, they're too stupid to know that, so they fall for these gimmicks. But I digress. Listen, a lot of stocks are down right now, especially over these last few days. As you've heard me say before, I don't focus on commodities. I could care less whether they go up or down. I'm looking at the overall broader economy. I think the automation, robotics, AI, electrification, digitization, trade, all these things still have plenty of room to move, and we see that because things like overall energy demand, even old legacy companies like ExxonMobil and Chevron, and especially the rebirth of companies in the nuclear supply chain, they're all doing extremely well because we need energy going forward. That's a sign of positive growth, and even on a day like today, when things especially like software companies are getting killed, and man, I'm almost ready to go in and buy some of those. But regardless of that, keep your eye on the banking sector and specifically on regional banks. If you follow my blog posts and alerts and notifications over at investablewealth.com, you know that I bought into the financial sector towards the end of last year. I think the blog post was November 12th. Check it out. Specific to that, I mentioned buying in and taking an overweight position in regional banks. I did that with the ETF, KRE. I didn't want to take specific stock risk within that category, so I opted for that ETF. The reason this is important is because regional banks are kind of like the ultimate canary in a coal mine, and a really good early warning signal not only for disaster but also for prosperity. These are the guys that on Wall Street are most representative of Main Street economy. The regional banks are the people that make the mortgage loans. They loan to small businesses. They invest in the local community. On a day like today, when big names like NVIDIA are down 4%, and Google and Amazon are all down 3% or more, what are the regional banks doing? They're up more than 2%. And so if Wall Street was really worried about a big meltdown of the general economy, they would not only be shunning things like the hyperscalers, but they'd be getting out of the small little canary in the coal mines regional bankers. Over these previous 5 trading sessions, regional banks up over 7%. For the month, up almost 10%. Over the last quarter, regional banks up over 20%. So no, I don't think the economy's falling apart. And currently, I'm not making any changes to my portfolio other than my watch list is getting larger, especially as these hyperscalers and software as a service companies see their valuations coming down to what could be very reasonable buying opportunities. So hey, stay tuned.